Good afternoon, ladies and gentlemen. This is Robert Rayburn here at LifePro Asset Management. It is Friday, May 13th of 2022. The date is definitely appropriate when we look at the chaos in the market that we've seen, not just really over the last 4 months, but in particular the last 2 weeks. The selling has been intense. It's been painful. And certainly when we look at our account values and, we're no different than our clients and advisors, we're experiencing that pain as well, is that we can definitely empathize with it. It's been a painful 2 weeks. But what we wanted to do this week is really take a step back, review the game plan going forward, and then also do provide some solace in the sense that yes, growth stocks have been at the center of this particular market panic, but when we look at the individual companies and businesses that we own on behalf of advisors and clients, a lot of these businesses are doing better and making more money today than they did when this panic in the market started. And I think that's the most important point. That's when we look at long-term, the strategies that have been able to generate excess performance over a 10, 20, 30-year time period, they don't get scared by short-term price movements. They don't incorporate stop losses to shake them out of incredible franchises. What they do is they do pen to paper, look at the numbers, look at the fundamentals. Are the businesses doing better or worse than they were before prices came down? And if they're doing better, you buy a little bit more. If they're doing worse, you sell a little bit, or you sell the entire position and move it into another company. And that's what we've been doing. And so moving forward, the game plan really at the end of the day remains stay focused on companies with incredible ROIC, return on invested capital, increasing profitability. They're capturing market share and are positioned as leaders in areas of long-term secular growth. So I'm going to go ahead and share my screen like I always do. And we're calling this week, understandably, what is the game plan? So we're going to go through what is causing that market mayhem, why growth strategies in particular have been bad in 2022. Should you be buying the stocks that are actually holding up the best right now? In other words, some of those more defensive areas of the market, such as consumer staples, utilities, in some cases energy. And lastly, is there a formal game plan and what is it? So when we think of that market mayhem, at the end of the day, it's been the triple whammy of rising inflation, war, and the higher interest rates that have resulted from these factors. All of these together have caused a lot of pain for growth stocks. Why? Because as rates rise long term, they cause multiple compression. We're going to go through that in a little bit more detail. But what the market is concerned about from a macro standpoint is that rising inflation is going to tax the middle class. And as you tax the middle class through inflation, spending comes down, growth comes down, and you get a recessionary scare, if not an outright recession. That's the first worry. Number two, that the Federal Reserve is going to make a mistake by rising interest rates, by jacking interest rates up too high, and therefore inducing a recession, which therefore goes back to worry number one of lower consumer spending. And then lastly is this concern around stagflation, that you're going to get growth that slows and possibly even contracts, which our work does not suggest that, but that's the concern of the market, while inflation actually goes up through rising commodity prices thanks to the war in the Ukraine. Now, all of these are very headline concerns. In other words, we see it in the news every single day. We see it impact consumer confidence. What we're going to go through today is that the factors that we pay attention to and that most fundamental analysts and portfolio managers and strategists pay attention to really do show a lot of durability in economic growth and very, very healthy employment trends. So it's really just the inflationary riddle that we have to tackle. So why the carnage in growth in terms of growth stocks versus value stocks? The first thing is we've seen vast multiple compression in stock valuations. So when we think of a growth stock, the area that we focus on, a lot of that growth is projected to take place way out in the future. So when those long-term terminal rates rise, so those 10-year interest rates rise, what a lot of quant managers look at is they say, well, that means that long-term growth is going to be discounted much more severely in a rising rate and rising inflationary environment. In other words, future earnings will not be valued as much as they were back when interest rates were only 1%. So they sell growth stocks and buy stocks where most of their earnings are going to take place in the short term and therefore less impacted by inflation and rates. Short term, that matters in the sense that you've seen the stock prices go down over the last 3 or 4 months. Long term, that doesn't matter at all. Look at companies like Apple, look at companies like Microsoft or Google or Home Depot or United Healthcare. They've been growth stocks by every statistical measure. And over the last 20 years, we've had rising rates, rising inflation, falling inflation, recessions, expansions. Guess what? A business that makes more money from an exponential standpoint is going to see and experience a rising stock price at some point. And so that's what we want to focus on. The other big thing is COVID normalization. That COVID normalization pulled forward a lot of demand for a lot of tech companies, a lot of digital companies that focus on helping companies digitize and automate their workflows. So we've definitely seen the rate of change slow in terms of that growth rate over the last 6 to 12 months, but we believe that rate of change is going to slow at a higher plateau than most other stocks in the market. And once the market prices that in, we should see stocks reprice back to the upside. And the most important thing is that we've seen no evidence that the underlying businesses have become impaired. In 2000, which is where we're seeing a lot of comparisons right now, that 2000 tech bubble, business growth tanked. In many cases, those businesses weren't even profitable at all. In fact, a lot of tech companies in the dot-com era didn't even have sales. The companies we focus on have strong sales, strong EBITDA margins, healthy and growing free cash flows, and after this multiple compression, have valuations that are even more attractive versus the rest of the market when adjusted for those growth rates. And we know it's been painful out there. I want to be very focused on that because, yes, the indices are down between 20 and 30%, but a lot of stocks are down way more. So we look at the NASDAQ, the percentage of members that are down 50% or more are approaching 50%. So almost half the NASDAQ is down 50% or more. That's striking, and that is painful, and that is why you see so much negativity and pessimism in the market. But if you're disciplined, have a long-term time horizon with the funds that are invested in those growth portfolios, now is the time to remain disciplined, or if you have extra cash, to start putting into work on some incredible deals that are taking place in the marketplace right now. So what we want to do is we want to focus on those X's and O's. We want to own a basket of companies that are expected to generate excess long-term return on invested capital versus the market. So is the economy entering a serious downturn? We don't believe so based on our work. Unemployment claims remain near record lows. Consumer balance sheets remain incredibly strong with low levels of debt relative to their assets and income levels. Housing remains strong. Yes, mortgage rates have gone up significantly, but guess what? Most people are sitting in 2.8% fixed rate mortgages. So we're going to have this weird scenario where, yes, affordability is an issue in the housing sector, but most people are not going to sell their home because that would cause them to swap from a 2.8% mortgage into a 5.3% mortgage. So inventory is going to remain pretty tight across housing. We should see prices come down a little bit, but not a lot. Nothing like we saw in 2006 to 2008. Number two, are our stocks doing better or worse today versus the start of the downturn? Unabashedly, across the portfolio, the vast majority of stocks are doing better. They're making more money. EBITDA margins are expanding. Profitability is expanding. That's feeding to better free cash flows. The only difference, lower price. We remember what we said about oil stocks last year. These companies were making more money. The oil price was up, but the stock prices were down. Now, we were early to depart those stocks, but it ultimately proved correct that the prices do catch up with the fundamentals. And we believe that this is going to remain the case for technology. And then lastly, are these companies self-sufficient? It's so important right now when you're in a period of market panic that you own and focus on companies that have profitability and are cash rich. In other words, it's okay to own a couple companies that have some negative earnings because they're, in other words, what they're really doing is they're reinvesting for the future, but they have to have the cash on the balance sheet to see them through a 2 to 3 year time period so that they don't have to go back to investors and raise more equity or raise more debt. That's really important. Those stocks can do really well from here. But other than that, we want to focus on cash rich, EBITDA margin rich, and companies that have strong free cash flows that can generate significant profits. That's where our focus is right now. And then, of course, stop losses. We get this question all the time. Well, at what point do you incorporate a stop loss? At what point do you say, hey, this pain is enough? Our stop loss is only fundamentals. If the fundamentals are deteriorating or we're seeing a broad shift in the market from one area to the other, we'll make that shift. But we're not going to sell a stock just because some people out there over a 1, 2, 3 month time period have voted the stock down with their short-term opinions. If the business is getting better, you stick with the business. If the business is getting better at a better rate of change versus the overall market, you stick with the business. Where you can sell a stock where things are getting better is if the S&P 500 as a whole is getting better at a higher rate of change than that individual stock. Therefore, it makes sense to sell that stock. But look at Apple. Apple has spent the vast majority of the last 18 to 20 years in a drawdown. In many cases, more than 10, 15, 20%. In fact, most of these stop loss rules use 10% as the trigger point to sell a stock. If that had happened, think of how many times you would have sold Apple over the last 20 years. And it's not just Apple, by the way. We can look at stocks like Home Depot, United Healthcare. We can look at Microsoft. We can look at Chipotle. Across the space, Lululemon. But every single time we've had drawdowns 40%, 60%, 40%, 50%, 70%. But over that entire time period, Apple's generated wealth creation of plus 41,289%. But all of these other naysayers out there over that same time period would have told you to sell because they hit a stop loss. Stop losses are an easy way for someone to say, you know what, we stopped your pain. It's an easy answer. But we believe in good parenting. We believe in good coaching. And sometimes that means a tough message saying, hey, you know what, the stock is down a lot, but the fundamentals are getting better. And honestly, the best strategy is patience. The best strategy is making sure our thesis is correct, that the numbers are correct. And if they are, to stick with a really good company, because that's how you create wealth. Lastly, center of the storm here, when we think of that March 2000 period when the NASDAQ peaked out way back, 22 years ago or so now, the NASDAQ and the dot-com bust had about a 78% peak to trough drawdown, right? Total sell-off about 78%. So what we're tracking is the Goldman Sachs unprofitable tech basket. So those aren't companies that we're invested in, but all these companies that have basically no EBITDA profits, no earnings profits, they just lose money. Those stocks are down about 75% plus from the peak back in, call it around February of 2021 through to today. So those stocks have had about a 75% plus drawdown. The reason why this is important is that a lot of this sell-off is baked in at this point. So if anything, there's probably a trade that we had in these unprofitable tech stocks. Now, that's not our jam. We're not going to go in there and start buying these things. But what I am saying is, if those have bottomed, you're going to see that reverberate across the growth space, in our opinion. So what are people doing right now? Investors are seeking what we call shelter stocks. In other words, they're discarding those Amazons and Netflixes and Facebooks and Teslas away, and they're going into their tornado shelters, right? So if we think of a tornado, I grew up in the Midwest. When you get a tornado warning, you immediately seek that tornado shelter, right? And that tornado shelter in the market has been companies like Clorox or Coca-Cola, Campbell's Soup, these types of stocks. The problem is everyone's stuffing themselves into the same safety stocks at the same time. So in other words, we're jam-packing ourselves into this movie theater of the same stocks to the point that those safety stocks are now becoming the bubble. So the question is, all of this is safe until someone yells fire in the movie theater, right? Or in the market's case, inflation has peaked. When you start to hear the inflation has peaked, that's when everyone's going to start dumping these stocks. That's when people are going to look at what are the stocks that benefit from a deceleration of inflation. So what is the lighter fluid? Well, the lighter fluid is a lot of the data that we got this week. So inflation, the media, of course, has said inflation got worse this week. No. When we look at the inflation data, we strip out new cars, food, and airlines. So that's just about 18% of the overall CPI index. Prices were flat. And notice what happened here. The number of rate expectations by the market by the end of December 2022. The market was pricing in over 10 rate hikes. We're now down to 7.5. And we've already had a few under our belt. And notice the market action today. So that's what we're trying to say, is that you want to be really, really careful. And so what actually makes sense? We got AMD as an example, projected revenue growth of 15% plus, earnings growth of 15 to 20% plus, trading at 20 times earnings. Or we can go by Coca-Cola with revenue growth of 5%, expected earnings growth of 6 to 7%, and trading at 27 times earnings. Clorox is trading at 37 times earnings. They're trading like a hyper growth stock. It's insane. That's where the bubble is right now. And that's where we need clients and advisors to be really, really careful. So what are the future trends? Think about the world, where the world is going, and what are the companies that are leading those trends? So do we want to invest in cloud computing, digitization of workflows, artificial intelligence, the genomic revolution, big power competition between the US and China, or traditional banking, steel and copper, high preservative foods, large industrial firms with little to no earnings growth? Which areas do you think are going to have longer term growth? Let's look at ServiceNow. We brought up that example 2 weeks ago, right? Rising cash flows, accelerating EBITDA growth, but a falling stock price, therefore it must be bad. We don't think so. So bottom line here, ladies and gentlemen, is that we want to ask the questions, are growth stocks right for me? What is my time horizon? Do I have 4 years plus of time under my belt so that I can put up with these 6-month stretches where losses are really painful, right? Those short-term losses are painful. Am I willing to put more money in at these depressed prices? How will I react to the stock falls further? If you're really affected by falling short-term prices or rising short-term prices, a growth strategy may not be right for you. But if you're looking at value creation and wealth creation over the long term, we think a growth strategy could be right for you. And how will I know if I'm wrong, right? The number one thing you want to look at if you're wrong are the fundamentals going against your thesis. And that's what we look at every single day. So thank you, everyone. I know it's been a very scary 2 to 3 months. When we look at the companies, we look at the merchandise, we look at the fact that these companies are better today than they were a few months ago in terms of profitability, revenue growth, cash on the balance sheet strength. That gives us so much confidence for what's ahead. And again, if anyone has any questions, please feel free to reach out to your advisor. Feel free to reach out to us directly. We're more than happy to help. Thank you again, and have an absolutely wonderful weekend.